Yeah, welcome to my third lecture of quantitative finance. First, before we start, I would like to have a small discussion or some minor comments on the RPM exam that has been taking place at the weekend on Saturday, as far as I remember. So, in the student guide that I wrote for you, I was highlighting that if a teacher gives you a hint or will explicitly tell you what you will ask in the exam, the probability is about roughly 100% that this question will also pop up in the exam. Right? So what did I tell you? What question I will ask in the first exam?
Sample paper.
Exactly. And what did I ask?
Sample paper.
Yeah. Exactly. So the questions started with Stumbo paper, so you were supposed to investigate the O's and O score and the failure probability. Yeah? Both measure distress, financial distress. So I gave you this small excerpt from the paper, and then I was talking about, I wanted to know if you can derive the three hypotheses and the idea behind that paper. And we were discussing about that. It was, of course, overpricing, and the reason was that investor sentiment has a common component that drives all stocks at the same price in the same direction, right? And the other was short sale impediment, like constraints, short sale constraints. And this both concepts combined basically lead to overpricing. And then we have the three hypotheses that we should derive and use in 1B. Yeah? So what's the first, second, and third hypothesis? First one is that the covariance between the long-short portfolio and investor sentiment is positive. And we put it as an alternative hypothesis because we want to reject the hypothesis. Second was that the short portfolio should respond, so the covariance between the short leg and investor sentiment should be negative. Again, this is the alternative hypothesis in the hypothesis test, and then we have as a third hypothesis that the long leg shouldn't respond. So the covariance of the long leg and investor sentiment should be statistically not be different from zero, which is our null hypothesis in the test procedure. Now, this is what we discussed a couple of times in the exercise session and also during the lecture. Right? And for both of these anomalies, everything is fulfilled. All the three conditions that are associated with overpricing are fulfilled. So in this case, we could say, yeah, well, investor sentiment drives or is a partial explanation for those two anomalies. Yeah. So I didn't have the time yet to look on the exams, but I'll do this on Friday probably. But this is basically what comes out, okay? So no big deal. We talked about it intensively during the lectures and as well also during exercise sessions. So then the second one here, it was about this new asset pricing model for Novimarks, and then you were supposed to find out which of these strategies basically have value stocks, so positive loading against the HML factor, winner stocks, so positive loading against this factor here, against the UMD factor, and are profitable stocks, so positive also against this factor. So figure out the strategy of this subset of strategies that have positive loadings against all of these factors. That's it. No big deal. Yeah. So that was the exam. Easy peasy. Full points. If you would have been a little bit paid attention to what I tell you, super easy to get 16 points here. So whenever a teacher is telling you that he will ask something in the exam, he will do so. For sure. Any questions? Okay. So last time, just to summarize what we have done, last time we were basically we wanted to estimate the beta loadings, our market sensitivities of our subset of 14 stocks that span our little stock universe here. So in our notation, this y vectors here denote the vector of excess returns for stock 1, 2, until 14 for the respective stock that we use. So for each single stock, we estimate this single equation model here, and what we get is the corresponding point estimate. So we use the same formula. We regress the excess returns on the market factor, which is our X matrix here. It's simply the vector of excess returns of the market factor in our very simple framework. So what we get is first beta. So then we do this next iteration. We do the same regression once again, but then we use the excess returns of the second stock and regress it again on the market factor, which gives us the second beta. And we do it 14 times until we end up at our 14th stock that we again regress on the market factor using the simple OLS formula, which gives us then the 14th beta loading. So this is what we have done. Then we have sorted this vector here because, of course, we don't know which of these beta loadings are in the low beta group, medium or high beta group, so we have to sort them. This is what we did, and then we have determined what is the, basically we have determined where to find each of these stocks that belong in group 1, 2, and 3. That's why we have coded this vector of zeros and ones. What we find, let me see, which we find here in the script. Yeah. So we have for each of these groups, we have determined with a very small code where to find those stocks, because the order in the original beta vector has the same order as our excess return matrix. Yeah? So each of these group vectors tells us exactly where to find these stocks. Yeah? So that's what we have done last time. So we have done this for all these 3 groups, and we were interested in the high beta stocks. Yeah? We wanted to figure out, okay, what's the return of the stocks that have a high beta. So this is where we ended last time. Yeah? We had defined our 3 groups. Yeah? We finished here with group 3. And what we then figured out is, okay, if we would add our 3 group vectors, what we should get is the vector of ones. Yeah? So because every single stock should only end up in one group. Yeah? You remember that's why we had we used these signs here, yeah? For determining these 3 groups. So in order to avoid that some of the stocks would end up in different groups. So then our portfolios would get polluted. And of course, if you have many stocks, then this doesn't matter. But if you have only 14 stocks, then it matters, definitely. So we want to keep our portfolios clean. Yeah? So what do we do then? Next is we want to determine what is the average return of those stocks that have a high beta in our stock universe. So again, basically what we do here is we do all the time the same thing. Yeah? So you will recognize that actually. So first we code a vector of zeros where we store in our results. Yeah? It's denoted here as average underscore red underscore high underscore beta is equal to zeros t by 1. So it gives us again a vector of zeros and 215 rows. Yeah? 1 column, 215 rows. So if we would write again here zeros 1t, what we would get then is the row vector. We would get then this guy transposed. So what happens here next? So next we again operate with a for loop. And now we want to store the average return for each point in time, starting at t is equal to 1, for those high beta stock portfolio. So what do we have to do? So in group 3 is a 1 by n vector. So this is 1 by 14. Group 3 is 1 by 14. And we multiply it times y1 and y1. We store the excess returns of our stocks. Yeah? So we multiply it with y1, and then we have small t in the row index and this double point for the column index transposed. So what does that mean? Remember our excess return matrix, and remember now that the first part here denotes our row index and the second is our column index. This double point, what I already told you, means take all the, in this case, take all the columns. Yeah? So we start at t is 1. It should take in the first row, t is 1, all the columns. So it takes now this guy here. So, and we have 14 stocks here, right? Our excess return matrix is 215 by 14. So this first row here is 1 by 14, right? So what do we have to do in order to compound the sum of returns? So what we first want to do is we want to sum up the returns, and then we divide it by the corresponding number of stocks in our portfolio, yeah? Which is the second command here, or what is here in the denominator. Sum from group, which sums up all elements that are in this vector here, in the parentheses, and which is in our case this group 3 vector, consisting of zeros and ones. So if we sum this vector up, it gives us the number of stocks that are in this group. So we have to build the scalar product here. We want to have a number here. We want to sum up the returns. So we have to get the same dimension here. So what we have to do is we have to transpose these guys. So we have to take the row where all the stocks are, all the returns or all the excess returns of our stocks, and our group 1 vector, as you remember, is a binary vector. So it's 1 by 14, so it's actually, it looks like that. Yeah. Something like that, yeah? It's 1 by 14. So we have to take this guy here and transpose it. We have to make of this, we grab this row vector out of the excess return matrix and transpose it. So then it's 14 by 1. 1 by 14 times 14 by 1 gives you 1 by 1, which is a number. And this is simply the sum of these elements here that have ones. It's a simple scalar product. Yeah? So take this group 3 vector, take the first row, transpose it, build the scalar product, and divide it by the number of stocks that we have in that group, in this group of stocks. So then if we take the sum of this group 3 vector, it gives us simply the number of stocks that are in this portfolio. Yeah? So what we get is the average return in essence. It's an equal weighted average return at time t is 1. So we do that, we put it into the vector that we here coded with zeros, this average red high beta, as the first element. So then we take the second element. Then t goes to 2. What happens there? Okay. It says, okay, store in this average red high beta vector, store as the second element, again, we take the group 3 vector, which gives us, again, the positions of the stock, and it's obviously always the same, yeah, in this exercise. Multiply it with the second row of excess returns, yeah, because then T is 2, and again, it takes all columns. So what we have then is, in the second iteration, it takes the second row here, where the excess return for at time T are 2 are located. And it's also 1 by 14. So again, it has to be transposed. We build the scalar product, which is a 1 by 1, which is just a number, like the sum of returns, and we divide it by, again, the number of stocks that we have in our group. Of course, we can also put sum of group 3 out of the parentheses. Yeah? What we could do instead is we can, for instance, we can define, okay, let be A1 the sum of group 3. We put this comment here either before or after we define this 0 vector where we store in our average returns. Yeah? And then we would put here into the code just this expression here divided by A1 instead of writing sum of group 3. Of course, that's possible. There's always, it's a little bit individual, and there are always different possibilities to come to the same conclusion. Yeah. But is this clear to everybody here? What's going on here? Yeah. So it does so until capital T. So until we have basically for all time series observations compounded the corresponding excess returns of the high beta stock portfolio here. So this guy here has some numbers, yeah, and each of this number is the corresponding excess return of our high beta stock portfolio for each point in time. So next, we wanted to investigate the Sharpe ratio. We wanted to investigate how good is that portfolio, how does it perform compared to the underlying stock market. Yeah? Because that's, of course, what we are mostly interested in. We would implement a trading strategy only when we expect that the strategy would beat the market return, right? Otherwise, that doesn't make any sense, right? So what's going on here? I define Sharpe underscore ratio underscore portfolio is equal to mean, and in parentheses, we put in the vector that we have just estimated here, or that we just calculated, the average return of the high beta portfolio. This is in parentheses here. And the mean command means, okay, take the average of what is in parentheses here. That's the mean command. It takes just a simple sample average of this vector that we have here in parentheses. So take the mean, and then this sign means divide it. Yeah? And then I have 3 points there. Yeah? What does that mean? Yeah? If you start writing a code in Matlab, yeah, and you use 3 points, it tells Matlab, okay, we want to continue with this formula, but the space is not enough here, so we continue with the formula in the next row here. So it belongs to the same command here. It still continues. So because there was not space enough to write the whole equation into one row, I continued here. So I want to divide the sample average, the mean of the average return high beta portfolio, by the square root SQRT means take the square root of a number of what is in parentheses, and what we have in parentheses is VAR. This is the command of take the variance of a vector that is in parentheses here, and here we have in the variance operator we have the time series of returns for the high beta portfolio, right? So it takes the variance of the time series of the high beta portfolio returns, and this is obviously just a number, and from that number here, it takes the square root, which is the volatility. The Sharpe ratio is the mean divided by the volatility. It gives you the unit of returns for each, or it gives you the expected returns for each unit risk, right? And the higher the Sharpe ratio, the more returns we get for each unit in risk, and the better the portfolio is. So that's how we code the Sharpe ratio of the portfolio. So next, what we do is we want to compare it with the Sharpe ratio of the index. So we define that as Sharpe underscore ratio underscore index is equal to, what is it? So it's the mean of x1. We remember the x1 vector contains the exact returns of the omics 30 index, right? So it takes the sample average first in the numerator, divided by the square root of the variance of x1. So it takes the square root of the variance of the time series of the exact returns for the omics 30, which is the corresponding index volatility, right? And I told you also that after each comment, we should actually write this colon, this comma with a dot. But we don't do it here because we want to know the corresponding values. We want Matlab to spit it out. So, and the corresponding, once you do that, for the data that I have uploaded or that I have provided you on Moodle, once you do that, what you get is the Sharpe ratio for the portfolio should be 0.1192. And the Sharpe ratio for the index should be 0.0945. What does that mean? Simple IQ question. Which portfolio would you have chosen? If you would have known that beforehand, of course.
The first one.
Yes. So the Sharpe ratio of our high beta portfolio is obviously slightly higher than the Sharpe ratio of the index portfolio. So that gives us a slightly better risk-return payoff. So in this case, it would have been beneficial, obviously, to invest into high beta stocks, given our set of assets. So what we can do then next, let me take this away here. So what we can do next is we can plot the time series evolutions of the exact returns of the index compared to our high beta stock portfolio across time. Yeah? This is what we do here with the plot command. We have encountered already this plot command earlier, right? But in this case, when we want to plot two time series in the same graph, what we have to use is we have to use two kind of parentheses. Yeah? The first one for the plot command, and then we have this kind of parenthesis. In Swedish we say fyrkantigt. I don't know how to say in English, but you know, it's a little bit like that. Fyrkantigt. So, and then we put in what we want to have, and this is the exact return vector of the index and our average underscore red underscore high underscore beta. Yeah. Then we close the inner parenthesis and we close the outer parenthesis. And if we then push the enter button, not putting here this colon, okay, because we want to see it, then we would get the following graph. Voila. So, and here is a little bit fuzzy, right? So the blue line should be the omics 30, and the blue line is the omics 30, and the green line, it says here in the description, the green line is the high beta portfolio. Yeah? So what you see already, if you're just steering here, that the volatility of this high beta portfolio is higher than the volatility of the omics 30. It looks more erratic. The time series looks more erratic, right? So, and I told you, if you go on insert here, first you plug in the plot command, then Matlab spits you out this graph here, and then you can go on. If you take the third button here, it will store this file. Then you have to give it a name. If you go on insert, then you can give it like table descriptions, yeah, for the x-axis and for the y-axis. So you just have to play around a little bit, and then you will figure out, of course. You know, you can also highlight some things here. This here is the highlighter. It's the icon below desktop. You can highlight certain dots here in a time series, whatever. Change the color, and if you like pink or rosa or something, you can just change the color. Doesn't matter. So, what's the problem with these analyses? There are many problems, but what's the key point here? What have we done? Can we use this strategy if we set up a hedge fund or something? What do you think? No. What we have done is ex post analysis. The data, we have already the data at hand, and then we implement our strategy. So it's ex post. We actually don't know if the evolution of this, if we implement a model, we have to backtest it as well. So if you work in the finance industry, and you have the data, and we are here in the timeline, we are at point capital T, and what we have done is we have investigated data of the past. So we don't know what is the payoff at time t plus 1, do we? No. So, but what people usually do when they implement a new trading strategy or a new investment vehicle, so they have the data set, they know they want to invest in these and these stocks or assets, whatever. So you divide the sample period into 2 subsamples, for instance 2. You treat the first subsample from where it starts at T0, and let's say this is T capital 1. You treat this as in sample period. And then you can consider, you keep this parameter, so you get some sort of, you run your model, and you get for this time period the beta estimate, for instance, beta I, and I is from 1 to, let's say, n, capital N. So you get your point estimate, whatever you use here as regressors, and you have a look, okay, what happens if I keep these point estimates constant? What would have happened in the out-of-sample period? So you'll treat the second time period here from, it starts at T1 plus 1 until capital T. This you treat it as out-of-sample period. Out-of-sample period. Okay? And then we have a look, okay, how does it look like? How would this strategy have performed in this out-of-sample period here? That's one thing that you can do, what people do. What you can also do is, if you have a dynamic model, let's say you start with, you have an in-sample window of, let's say, T2 observations. You treat this as in-sample window, and then you update this model all the time, iteratively. That's why people use Matlab and Python and R and so on. So you get beta estimates or point estimates for this first time window, then you move it one step further. You get new point estimates. So you make prediction one step ahead. You move the time window again one step further. new information arrives. So you again make a one time ahead forecast, and so on and so forth. So you move the time window, you keep the time window constant, that's a capital T observations, and you cut off the earliest observations because you say, okay, the information that we have in the early sample period, where the data begins, maybe not so important if we are here already. So you remove these observations and you say, okay, the relevant data is the most recent data here. That's my learning period. Yeah? So it's a dynamic model. So you move the time window of, let's say, capital 2 observations always one step, 1 month in our sample, 1 month further. And then you get new estimated, new predictions for each point in time. And you can do this for monthly data, weekly data, daily data, tick data, whatever. So what we do next is, okay, we want to see if we would have implemented this tailoring strategy here at some point here, how would have been the performance in the out of sample. This is clear to everybody? So that's what happens here in section 3. Yeah. We consider 2 subsamples of monthly data. We use the first 150 monthly observations as subsample 1 to repeat the previous exercise. That is, we use past information to make inference about future returns. Again, sort the stock into 3 groups. The first group containing 30% of the stocks exhibiting the lowest beta. Then we have the medium group where we have 40% of the stocks. And then we have the last group having 30% of those stocks with the highest beta. Then again, if necessary, round down the number of stocks. Now, remember, that's the floor comment here. Again, now having estimated the groups with low beta and high beta, we construct equal weighted portfolios containing the high beta group and use the second subsample for asset allocation. Yeah? Again, estimated Sharpe ratio and compared with the omitted 30. You know, just because it works for the whole subsample, it could be, in our initial analysis, it could be that this trading strategy was very profitable here in the later subsample, but not profitable here. We don't know that. It could be that the whole profitability was driven by this later subsample. And this is now what we want to investigate. Yeah. So it's always good, you know, if you don't really know what's going on here, to make a small picture for yourself, because things get more like intuitive once you have written it down. Yeah? So, what's going on here? So again, we have still, you know, you remember, once we write something in the command window, everything is stored in the workspace in Matlab, yeah? Everything. So we have the matrix Y1, our excess returns matrix, it's already stored in the workspace. So what we do here in the first step is we code a new matrix. So basically what we do is we copy Y1. We call it YY. YY is equal to Y1. So Y1 needs to be already in the workspace. Yeah. So in order to write this equation. So now we have copied this matrix, and we do the same with the excess return matrix. So we define XX as X1. So next, we define our Y. We say, okay, Y should be YY, so in YY is now Y1, it's our excess return matrix. And it says in parentheses 1 double point 115. One double point 115, comma, double point. And then again this colon here. So it says, okay, give me a matrix, call it Y, and this matrix should have the first 115, so row 1 to 115 of the YY matrix, which is our excess return matrix, and all columns of it. So this matrix here that we then defined, our Y matrix, has then a dimension of 115 by 14, right? Because all columns, we have 14 columns, yeah? And row 1 to 115 is 115, obviously, so it's 115 by 14 matrix. So Y is element of 115 by 14 matrix. So then we define our vector of excess returns. We want to have the first 115 observations. It must be, of course, time congruent. Yeah? So what we then say is, okay, let's define x as x is the same like x1, our excess returns from the market factor. Again, take the first 115 observations. And because it's just a vector, we don't have to write this double point afterwards, yeah? Because it's just a vector. So if we would write here, just as an example, so just that you get to know what's going on here. If we would write here instead of double point, let's say, instead of double point, 5 to 14. Yeah? What we would then get is, we would get a matrix that has the first 115 rows of the excess return matrix and stocks 5 to 14. Yeah? So the first 4 stocks would disappear. Yeah? So what we would get then is a matrix that has dimension 115 and 10. Yeah? So just that you know how things are working out. So now we have restricted the sample to the first subsample. Yeah? That's what we have done. We have restricted the whole subsample to the first subsample. We just want to access now the data of the first subsample. And then what follows then is samayukto, as we can say. It's the same thing that we have already done, as you see here. So we define the length of y. Y is now 115. We could also write here length of x. Yeah? Then we have k is 14. It's the number of stocks. Then we define our beta vector, where we want to store our results. Beta is, first we code a vector that has zeros, 14 zeros. It's a column vector, 14 by 1. What we do then is we do our OLS formula here that we know already. Yeah. We again form a for loop here. We do this 14 times, like in the beginning of the lecture. Yeah, you remember these regressions, so we do it now 14 times again, but for the first subsample only, because we have restricted the data. Then again, beta underscore sorted. We do the same thing once again. We sort our new beta vector that contains now that's now conditional on the first subsample. Yeah. Then again, we define these 3 groups here. It's the same thing in the code like in the earlier code. Yeah. I have just copied it here. So we do the same thing all over again, but with the new data, because we have overwritten the data here. Yeah. We just restrict it to the first subsample now. So this is nothing new what happens here. We know that already from last lecture. So what do we do then? Now we have to restrict again the sample period to the second subsample. So now we want to know, okay, now we have the group 1, 2, and 3 vectors after we have done these operations here. Yeah? And these group vectors here are not changing. So the group vectors that we have defined here, giving us the low, medium, and high beta stocks, conditional on the first subsample now. Yeah? It's conditional on the first subsample. And if the betas are constant over time, the same stocks should be also in the second subsample in the same portfolios. So we treat them now. We assume, okay, the cat-m works and everything, and the first subsample provides us enough information for our portfolio sorts, and we want to see now, okay, based upon this information, and we have determined now our high beta stocks, let's see how the performance of this high beta stocks is in the later subsample. So we use this group 1, 2, and 3 vectors, and now we want to multiply, you remember now, we have to multiply the excess return matrix with the group 3 vector, right? Because here we have the high beta stocks conditional on the first subsample. So we have to multiply now this group 3 vector, which with the row 116 to 215, because this is our out of sample time window. Yeah? So we have our excess return matrix, excess return matrix, yeah, which has 215 by 14. So we use now the first 1 to 115 observations for estimating these group vectors. And now we want to multiply every single row from 115 plus 1 plus 2 until we end up at 215. So we have to grab this row vector here out of the excess return matrix, transpose it, multiply it with this group 1 vector, which gives us again the number, and divide it by the number of stocks in our corresponding group. So it's the same thing that we have already done, but before that we have to restrict now again the sample towards the second subsample. So we overwrite our Y matrix that we use in the code, so we overwrite it. We define it as YY, 116 to 215, yeah, to give us these stocks here. The excess returns from 116, T116 until T215, comma, double point. So it gives us, again, we want to access all the stocks. And it must be like that, otherwise we would get an error, because our group 3 vector has also the dimension 1 by 14. Yeah? So we need to have all stocks, yeah? Which is 1 by 14 transposes 14 by 1. So if you multiply 1 by 14 times 14 by 1 is again 1 by 1. It's again this sum of the excess returns divided by the number of stocks, and we get the excess return for each point in time. Yeah? And also here, our x, of course, we have to also to access the excess returns of the OMX 30 for the time congruent period here, which is also 116 to 215. Yeah? So again, we restrict now our dependent variable and independent variable to the second subsample. And then again, we use the same code like in previous lecture in order to compound the excess returns. And also our t changes now, okay? T is now 100. Because we can also write length of, instead of t is equal to 100, we could also write t as length of x. Yeah. Then Matlab would recognize the length of the time series that we use for the second subsample. So what do we do then? It says again here, calculate the Sharpe ratio of the portfolio for subsample 2. It's the same thing that we have already done. Yeah? Sharpe underscore ratio underscore portfolio should be the mean of average underscore red underscore high underscore beta of this high beta stock portfolio divided by the volatility, yeah? The square root of the variance of the same time period, of the same time series. Then again, we also want to have the Sharpe ratio of the market index for the same time period for the second subsample. So we define Sharpe underscore ratio underscore index, it's the mean of x, running now from 116 to 215, divided by its volatility. Yeah. So, and then what we should get here, what Matlab spits out, if we would not push this, if we again do not write this colon after the command, we just push the enter button, and what we get then is that the Sharpe ratio of the portfolio should be 0.11, and the Sharpe ratio of the index roughly 0.10. So again, even after conditioning the information, the estimation period on the first subsample, and then keeping this weights or this portfolio allocation constant in the second subsample, even then we would have generated a slightly better payoff using high beta stocks. Yeah, so in this case, in this special case, this strategy would have worked out actually. Then again, we can of course plot our time series now. Same thing that we have already done earlier, this plot command. Then we can see the time series evolution of these two portfolios for the second subsample here. Over time, it looks like that. I plotted it here. Again, the green line is the OMX 30, the market index, and the blue line is our high beta portfolio for the second subsample. Yeah. Any questions? Is this clear to everybody what's going on here? Otherwise, you can ask now. And actually, another thing that is not so funny, in the RFM exam, there was obviously one candidate who was using the mobile phone, Google, during the exam, and yeah, I mean, you know, I'm telling you, your mobile phone, your cell phone is your enemy number one. This is what I'm telling you. So don't let your mobile phone ruin your life. So I had someone that I know. I would not call him a friend. It's just someone that I know. It was also many years ago. So the guy was, he was not like super smart. He was like average smart, I would say. And he was at a job interview, and it was many years ago, as I said. And during the job interview, for a quite decent job, I would say, conditional on his background and his education, during the job interview, his cell phone was ringing. Yeah. So what do you think? Did he get the job? Yes or no? Yeah. Of course not. Yeah. Of course not. So I mean, if you are not happen to be a CEO of Goldman Sachs or so, I mean, then I would recommend to make the cell phone silent in a social interaction. Yeah. So if you have a date, yeah, and your mobile is ringing all the time, this will be the last time that you see the guy or the girl, depending on, you know. So this is for sure. So I mean, there are some social rules, you know, and you know, if you see a group of people interacting, you know, like a group of 5 people, and all of them have their cell phone here, they are not. First of all, they are not very present, anyways, in their social interaction, and it's not smart, you know, it's dumb. So I mean, smartphones make you dumb actually. So be careful with that. I mean, don't ruin your life with that, you know. Just my humble advice. Okay, so last time we have derived the OLS estimator, right? Yeah. So we have this formula, standard formula. Yeah. And then our framework X is the regressor matrix, and it can be in the cap M case. We have simply let's say we have even an intercept term here. Let's make it more proper here. The first column is a vector of ones. Second column is the vector of excess returns for the market factor, which can be anything S&P 500 or the OMX 25, whatever. And let's say we have also a vector of size of the size factor here, small minus big, t is 1, and so on and so forth. Size factor at time capital T, and we have the value factor, HML at time t is 1, HML at time t is 2, until capital T. So in this case, this is now our regressor matrix. This is our X, or let's write it here. This is our X. Yeah. So what we would get then here, our point estimator, if we have here one stock return series like y1, and here's our beta 1, beta I, and our yi. So what we would get then is a vector that is 4 by 1, because we have 4 regressors here in our matrix. So our corresponding model that we have estimated here looks like that. It's our regressor matrix times the parameters, and we have this error vector u. What we can also do is we can rewrite, or we can reorganize that here, and we can say, okay, we define this first submatrix here. That's our x1. And the size and HML factor is our x2. I would make it maybe in red. So we can do that. We can divide this data matrix here into 2 subparts. That doesn't matter. So our X is basically then nothing else but the block matrix consisting of x1 and x2. So we can do that. It doesn't matter how we write it. And then if this is our notation, then we can reorganize this equation here by x1 times beta 1 plus x2 times beta 2 plus u. Same error vector. Now we have just divided these 2 matrices into 2 submatrices, in order to get our point estimates. But it doesn't matter. It's equivalent. But what is now interesting is, okay, let's assume the real asset pricing model is the Farmer and French 3-factor model. Yeah? So the real async pricing model contains both submatrices. Yeah? It's X. It's X1 and X2. Yeah? So that's our real model, real life. This is what we for now assume. So but what happens if we would estimate our point estimate, our beta loadings, using the cap M only? What happens if we would just use the first submatrix here? So what we would get then is our, let's say, our beta vector, conditional on the information on this submatrix here. Is X1 prime X1 inverted times X1 prime Y. Yeah, I now neglect the I index here. Okay, it's clear that I use a stock return here, EX return. So that would be our beta, our estimated beta vector. So this would be our estimated market sensitivity, or what we would get is the intercept term, the alpha, yeah, because we have an intercept here, a vector of ones, and we would get the market sensitivity. What do you think? Can we use that here? Is this a good point estimate for the market sensitivity? If we do not use the information that is actually in the second submatrix here as well, can we use the point estimates here for making statistical inference? So last time we have seen if all the conditions of the OLS model are satisfied, we have seen that the expectation of our point estimates is equal with the real parameter vector. Yeah? Given that all conditions or assumptions of our OLS model are satisfied, only then the expectation of our point estimates, of our betas, correspond to the real, or will give us on average the real numbers, the real parameters. But what happens here in this case when we use the cap M? But that's not the real model. The real model is a four-factor. It's a three-factor asset pricing model, including an intercept term. So it has four regressors actually. So the question is, what is the expectation of our point estimates? So let's just rewrite the equation. And now we put in for y what it is. Yeah, so y is what we have here. It's x1 times beta 1 plus x2, which is this guy here, yeah, times beta 2. So, and we have to take the expectation from that. So what happens here? So first of all, we know already the calculus rules from linear algebra. So we can move in the first term here into the parentheses and multiply the parentheses out. So this guy times this guy plus this guy times the second term in the parentheses. So if we multiply out the first guy here, what we get is basically we multiply the inverse of the same matrix product here. So what we get here is the identity matrix. Identity matrix times our beta 1 parameter estimate. So beta 1, and what do we get if we multiply the first part here with the second term? We do not get the identity matrix here, because it's not the same. We multiply, in the second position is x1 prime times x2. So this guy here times this. So what we get is then x1 prime x1 inverted times x1 prime times x2 times beta 2. So again, the expectation operator is linear, so we can move the expectation operator into the parentheses. And what we get is that the expectation of our point estimate, the expectation of beta 1 is beta 1, so it's beta 1 plus what we have left. So x1 primes, x1 prime x1 inverted times x1 prime times x2 times beta 2. And that's unequal to beta 1, right? So what we get is, in biased estimate, the expectation of our OLS point estimator is not beta. It's beta plus some linear combination of beta 2. It's polluted, so our point estimates are polluted by beta 2, by the regressor matrix that we have neglected. Yeah. So beta 1 is biased. Our market loadings here, our sensitivities against the market factor are biased, so we cannot use it. Yeah. So we cannot, it doesn't make any sense to make inference on something that is wrong. So if we use the wrong asset pricing model, this is what happens. Yeah? We get biased point estimates, and what we think is high beta could be low beta as well, or something. Who knows? It depends on what's going on here in the second term of the equation. Yeah? That's problematic. So it's important to know. I don't know if you have talked about this in econometrics. Did you? That's at least something to think about. So whenever we use a wrong asset pricing model, what we get is biased estimates. And where do I have it? Oh, I need some chalk. Maybe I can go with that here. What about the residuals then? Yeah, we get all the estimates for the residuals here, right? Every regression model gives us estimates of the residuals, of the uncertainty. So the corresponding residuals using the wrong model are my, m1y, and that's y is now, again, we have to plug in the real equation, what it actually is. So that's actually x1 times beta 1 plus x2 times beta 2. So, and what is m? m1 is the identity matrix minus x1 times x1 prime x1 inverted times x1 prime. So if you transpose m1, what you get is m1. So this matrix here is idempotent. Yeah. So what you get is that the expectation of using the wrong model looks like that. It's a function of beta 2 plus the real divided by the degrees of freedom, which is t minus k1 minus 1. And k1 in our case is 2, because we have here 2 variables in the first regressor matrix. So we get a term. We have here the real residual variance, which is sigma squared. And we have an additional term here that biases the estimates. So your homework is to think about, to derive this using matrix algebra. How do we come from this equation here? I will give you the solution probably on Sunday. But think about that. So what we get is the variance, or the residual, or the expected residual variance is overestimated. Because what we get here is something like a quadratic term. This is positive. So whatever is here in this matrix here will be positive because we multiply it with itself, with the same vector beta 2. Even if the elements could be here negative, because we multiply it with itself, what we get here is positive. So our estimated residual variance is overestimated. It's too large. That means the point estimates are wrong. The t-statistics are wrong as well. Because this guy here we need for the covariance matrix. This is what we will do next. We want to know, once we have estimated the point estimates, we want to know, are they significant? Are the point estimates significant? And for that purpose, we need, among others, the residual variance and the covariance matrix of our parameter estimates. So once we know what's going on here, we can easily put it into Matlab, and we can do it for how many assets you ever would like to. But this is what, actually I had a little bit more things here on my plan for today, but I will not start now with the second part, with deriving the covariance matrix for the point estimates. We will do that next time. But think about what's going on here, what happens when we use the wrong model here, what happens to our parameter estimates. They are biased. The residual variance is biased. Therefore, the point estimates, so the t-statistics for our point estimate is biased as well. So we cannot even use it. So I told you from the beginning on, you have to know what you're doing. If you use these toolboxes, you don't know that stuff, right? What you will deliver is wrong inference. You will do wrong analysis. And this could cost you your job. When I was working as an analyst, I did once a mistake as well. I did a mistake. And then I had a conversation with the CEO, and after that I was very, very careful what I did. I checked everything not only twice, maybe 7 times before I delivered my projects. So if you do one mistake, people say, yeah, ingen gong, one time is nothing. But if you do too many of these errors, and in particular if they are costly for the company, then it's the journey is over. So you have to know what you're doing, and you have to know what happens if your inference gets wrong, and have that also in your back mind before you report your results. Double check everything before you go to your manager, so that everything is in order. Okay. And usually the CEOs of these big companies, they are not stupid. So these are usually pretty smart guys, and they usually know what they do. So, yeah. Are there any questions for today? And you know, in the beginning, it might, some of you might like be a little bit like scared or something, you know. But once you get some basic concepts in the first 4 or 5 lectures, the rest is easy peasy because we put everything together. So don't get scared or defensive. It's no magic here, you know. It's no magic. Just plain econometrics. Okay, if there are no questions, then let's continue tomorrow.